Top African finance and policy leaders met in the Kenyan capital, and they're making the case for Africa-led funding in order to drive sustainable long-term growth. At the just concluded Africa Investment Conference, they called on governments to boost cross-border investments and to deepen capital market ties in order to attract a lot more capital and a lot more investment and hopefully in the process boost economic growth. This event was organized and hosted by the East African chapter of the CFA Society, and the forum highlighted the need to harness opportunities in the African continental free trade area amid rising infrastructure and tech investment needs. They also called for mobilizing a lot more domestic capital and way stronger regional linkages, stressing that Africa has to compete globally by building out its own financial ecosystems. Let's bring in Francis Nasyomba, CEO of Raising Capital, who's also the president of the East African chapter of the CFA Society. He's joining us in the studio tonight. Thank you for your time.
Thank you, Raman.
All right, so let's start with, I guess, that big picture question. What is it that stops African countries or African capital being invested in other African countries? Because the need for infrastructure clearly is there. But most of the time, when you have these big ticket projects being announced, it's always capital coming from outside the continent.
Yeah, thank you. And that's a very good question because most of the time, like you say, it's not that there is no capital. Actually, if you look at it, the African pension funds control more than $700 billion. Yet this funding does not end up in the other countries. There are a number of reasons, and one of the most obvious one is policy. So the policies that we have, most of them are national, country-led. Even the incentives, they are actually localized. Yet these projects, if you look at them, most of them are cross-cutting and regional. So in the end, you get that a project or an infrastructure project starts at one end and stops there, doesn't go to the next country. And it also makes the funding not be able to cross to the other countries.
So when you talk about policy, you're talking about capital allocation rules. So for example, I know in Kenya's case, it has to be X amount of money that, like I know in private equity, you can only invest up to 10% of funds under management, up to 30% in immovable assets, infrastructure, and so on and so forth. And in some countries, it's even more extreme because like in Morocco, they'll say you have to have at least half of your capital parked in domestic securities. Those are the barriers you're talking about.
Those are the barriers. So you get that a pension fund in Uganda may actually be able to see opportunities in Kenya, but being able to shift that capital, same risk, same profile and all, but being able to shift that capital to invest it in Kenya, they have restrictions when it comes to policy. But that said, there is also the other challenge of some of these projects, they are actually not what is famously called bankable. They're not investor ready. They've not had very good feasibility studies done. And even if the feasibility study has been done, the risk allocation and the sort of capital required has not been defined very well. So you end getting that either the project doesn't take off or it's funded by development funding, yet it's not supposed to be crowding out private capital. It's actually supposed to be crowding in the private capital, de-risk the project, then be able to invite private capital to come in. So those become some of the challenges, yeah.
What about the currency issues? I mean, I know within regional economic communities, you can say that there's some countries that are pretty straightforward. They sort of made baby steps to try and make those, to loosening rather, those capital allocation rules. But part of it also just comes down to the fact that you have tons of capital controls in some markets, enormous amounts of capital volatility as well.
Yeah. So when you look at the currency issue, it's a major one when it comes to Africa. We have more than 40 currencies. So every time, if you are in Kenya and need to invest in Nigeria, you have to go through two loops of currency. Change first, convert into the USD, then convert from USD to the Naira. And in the process, there's a whole lot of loss before you even start investing. That by itself means
and that's assuming that the Naira is properly priced.
That's assuming they're actually both properly priced. And that means you need an extremely high level of return for you to just consider that project. So currency is a big risk. And of course, we've talked about having this universal African currency, and it may not be in the near future, but it's one of the reasons that's actually making investing in other countries become a very big challenge. And as you mentioned, the pricing of currency, each country has its own policies and approaches of how to manage their currency risks. And it means in every time you look at any other country, you're taking that risk. If you add to the other element that most African financial systems are actually short-term, yet infrastructure projects are very long-term projects. So most of the funding ends up preferring the risk at the short-term end, while the long-term risk is not taken. Yeah.
And that's a structural issue, isn't it? Because if I'm a fund manager, and in as much as we can say, Francis, we need to invest in roads, in power, and so on and so forth.
Yeah.
But if I can earn 15%, right, on local government debt in Nigeria,
Yeah.
or like in Kenya's case, as it was in 2024, 15% on debt that's less than a year in tenure, it's so much harder to convince anyone that, look, we need to essentially avoid, to make that trade-off from double-digit returns, right,
Yeah.
inflation-adjusted returns in local government debt for IAR numbers that are going to be stretched out over 15, 20, 25 years.
And you're right, unless you're investing mainly because of patriotic reasons, where you take the loss for the case. But government is basically, in the end, ending up crowding out the long-term investments. And to be able to structure it properly, then we may need to consider a situation where the development types of financing, the blended types of financing, only play in to de-risk the projects. And then you allow the private sector be able to take the other chunk of the risk once it has been de-risked. And in that case, then it's possible for a private investor to be able to balance the return with the risk-adjusted return, because right now that risk will be have been sort of reduced, and they can be able to take that lower return because the risk is now low.
Why should people be thinking about de-risking projects in Africa? When I look at the results of companies like the Africa Guarantee Fund, for example, and we've heard this argument around the conference circuit, especially this year, default rates on infrastructure projects here are not as high as a perception would lead us to believe, right? So it seems at face value there's a mismatch here, because on one hand we keep talking about, well, we need to de-risk this project, we need to de-risk them, but then you look at default rates and they're not that high.
And it's because the de-risking should be happening pre-project. So the default rates are low because the projects that become live, most of them have gone through a whole lot to be de-risked, including the Africa Guarantee Fund's efforts. We are seeing the likes of AFC, who are at the conference, who talked about the fact that they have now to develop their own projects. They have to develop their own, like the Lobito corridor. They are actually developing the project themselves. They have to de-risk it before they bring it to the market. Once it's in the market, the default rates are low. But there are very many projects, and there was an argument, is it 60 or 80%? Actually fail at the feasibility stage, meaning many of the infrastructure projects are not coming up live. And when they don't come up live, yes, you have these ones which are successful, but they're not successful because they're successful because they've been de-risked, one, but it means very many of the others don't come to life, which means we don't have the infrastructure projects coming up here.
One last question for you, because we've spoken about, and I know this came up at the conference, the structuring projects to match the realities, the economic realities of African economies. For our viewers outside the continent, what does that then translate to in more tangible terms?
So in terms of structuring the projects to actually meet the reality, the most important thing would be, when you are structuring the return, the incomes, they need to actually match. So whether it's the end user who's paying, whether it's government taxes that are going to pay, then we need to be able to structure these projects so that all that income and the revenues are matched to this other end. We cannot structure it the way they are structured in the developed world, because that mismatch is actually one of the reasons we actually get defaults.
And we don't have a sort of secondary market for trading some of this debt and moving risk from point A to point B.
And further challenges, yes.
Indeed.